In today's video, we're going to be taking a look at some buy and sell signals both on a macroeconomic level and microeconomic level. In layman's terms, what that means is we're going to be seeing both on a company-specific level when I might be buying and when I might want to sell, as well as in the broader market and things that might signal that it's a great buying opportunity or a time to be selling. First, a quick plug. If you want access to my trades, products, and many more perks, check out the link below. We're going to take a brief look at Taiwan Semiconductor just so that we can gauge some of the microeconomic, but starting off with the macro. From a macroeconomic level, many people would take a look at the Dow Jones, the S&P 500, the NASDAQ, which are all market indexes, and you can tell here when there's events where those indexes are dropping 20, 30, 40%, those are pretty infrequent, so those are going to end up being pretty good buy zones. But there's also another way which I actually like to use, and that is looking at volatility. So here's a couple of volatility indexes here. At first glance, these are a little bit confusing, but when you look and you see where the real spikes are, you can see here that there's certain areas where it would have been a good buying opportunity, and this is just saying there's a lot of movement going on in the market. So here, March 2020, there was a big amount of movement very quickly, and that's what this big spike is. And looking back, 2008 would have been a great time to buy. 2011, probably the same story. 2020, March 2020 would have been a great time to buy. And we see that where we are now is not exactly in the same situation as 2020. We're actually very flat and there's minimal volatility. So that doesn't mean it's a bad thing. It doesn't mean you should be selling, but we can stay at this level for a long time and it doesn't have to spike up. It doesn't have to have large volatility or sell-offs. If you do check out the volatility of the markets, this is another great buy signal where you can see from a macroeconomic level. On a business-specific scale, when it comes to buying and selling, I'm looking more at the valuation. So that would include price-to-earnings ratios. It would include the market cap. I want a low valuation compared to what they're earning. For instance, if this company were trading for 15 price-to-earnings rather than 28, almost 30, it would be half as expensive. I would be earning back my investment in theory twice as fast. A company with a smaller market cap is always going to have an easier time growing at a faster pace. So for this company, it's almost $1 trillion. If you think about it, Apple, Nvidia, Microsoft are all roughly $3 trillion companies. So unless you believe that Taiwan Semiconductor is going to become even bigger than all those companies and grow to a $3 or $4 trillion market cap, there's some upside cap with how big it can grow to. Basically, I look at this and I think, unless I think it's going to get bigger than those companies, or those trillions of dollars are going to become worth less over time through inflation or whatever, money printing, there's only about a 3 or 4x potential in the very best case scenario for the time being. Of course that can change, but in general, that's just how I look at it. When it comes to selling signals on an individual business basis, I would be looking at this and I would be thinking, if I see these reds pop up, especially for gross margin, operating, net margin, and free cash flow, I don't want to see their margins deteriorating. So if all of a sudden versus the industry, they're losing market share, that would show up in their gross margins going down. And then if their gross margins decrease, their operating, net, and free cash flow should also be decreasing because they're losing market share to some other competitors or whatever reason, and vice versa. For a buy signal, I want to see these margins increasing. I want to see this company taking market share from its competitors. Another thing I might be looking at is if this company were to be at its highest price-to-earnings ratio, it's not necessarily a direct sell signal, but if it's at the highest it's been in 10 years, there should be a good reason. So when there's a high price to earnings ratio, there's a lot of growth priced into the business. Sometimes that becomes unrealistic. Another major thing that I've been looking for on a microeconomic level is insider trading. So if we see companies and their CEO or their executive office is selling many shares, that's just not a good sign. I don't want to be in a company where the management doesn't believe in it. And it's counterintuitive. Why would they be selling if they believe the stock is going to keep going up and they believe it's a great company? They generally only sell when they think something bad is in the future, or they have some information that we don't have access to. Another place where I saw this recently is in VFC, and the new CEO of the company is actually taking large compensation packages in shares. So I believe that's a good signal. I do think he believes in the company and he wants to turn it around, and that just aligns better with being a shareholder when the insiders of the company are actually buying the shares or holding the shares and increasing their quote-unquote risk to their performance of the company. Another time that I might be selling a business is when the valuation is ridiculous, and it all depends on what you think the company is going to grow at in the future and how realistic you think your expectations are. So we can see here in the last 10 years they've achieved 15.9 for earnings per share, and that's currently priced in, but people are obviously expecting this company to grow even faster. So currently there's about 21% priced in. So they expect the company to grow its earnings per share at 21 roughly percent for the next 10 years annually. And that could be possible. There's a lot of things going on with AI. I wouldn't bet against it, but it all depends if you think that's realistic. If this company were to be priced at 30% a year, it gets a little bit less likely, because the higher up you go with your annual growth rate, the less likely it is to actually happen. So if you end up seeing 30, 40, 50, 60% growth that's required over 10 years to equate to a fair value, then obviously that's going to be very difficult to achieve. It's not saying it's impossible, but very difficult to achieve. And that could be a sell signal, or a signal to me as an investor that the price is nowhere near being fair or cheap, and I could be assuming a little bit extra risk just by owning that company. And obviously vice versa, if there's very slight amounts of growth priced in, let's say there's 10% priced in for the next 10 years to equal fair value, but in the last 10 they've achieved 20, the last 5 they've achieved 30, the last 3 they've achieved 50. Obviously you can see there's acceleration in those earnings per share in this hypothetical situation, and that would be a very good buy signal, because the valuation would be very cheap compared to what they're actually growing at over all those time frames. And of course there could be valuation problems where maybe some headlines came out and they lost a huge customer or something, like with that video I posted on ANET. If they were to lose Microsoft and Meta overnight, then we would see a huge reduction in valuation, and a smaller growth rate could be reasonable if that situation were to happen. This is just a few signals you guys can use to know when to be buying, when to be selling, and just get a better gauge on valuations and how to make safer, smarter investments. If you like this type of content, please leave a like. If you have any questions or comments, leave them down below. If you're not subscribed already, I post videos like this and different types of videos also weekly, and I'll see you next time.